Tom Lee just made a major statement on CNBC saying, "The market is hinting at something massive," while also warning that investors could face some serious tests later this summer. In this video, we're going to break down exactly what Tom Lee said about AI, inflation, the stock market rally, and why he believes the AI revolution could be much bigger than most people realize. First, I'll show you the CNBC clip featuring Tom Lee. Then after, I'll give you my own reaction and breakdown of his biggest points, including what I think investors may still be underestimating right now. And finally, I'll dive into two of the best AI energy stocks to buy now as the artificial intelligence boom continues to reshape the market. Let's hear what Tom Lee had to say.
Tom, how do you assess this?
Well, I agree that the U.S. is benefiting the next 3 years, maybe even 10, 20 years from its leadership in AI. But I kind of agree with Professor Siegel that, if I look at the next 3 months, so not 3 years, I do think three tests are emerging for the stock market. One is, of course, how is the Fed going to react to both the underlying inflation risks? The second is, the market doesn't really like when inflation is a concern and yields are rising, and I do think we are seeing it now in PPI. I think there is in the pipeline a lot of inflation, not structural, but just inflation shock, but also energy shortage. And the third, of course, is I think we have a lot of IPO, and that's a lot of supply. So I think we're going to face some tests later this summer. So I think the risk reward is still great for tech, but I'm not sure about the broader market.
Tom, you painted a bit of a conundrum for you, perhaps, and maybe other investors, when you said, yes, I still am bullish on the AI trade, but I don't really like other parts of the market in the environment that we could be in with inflation in the pipeline, as you said, and shocks in inflation, nothing structural, but nonetheless concerning, the rise in oil, the backup in yields. But then if I sit back and I say, well, how can I lean in now to parabolic moves that have already taken place? And at the same time, I don't like any of these other areas of the market because I agree with Tom. Then what in the world do I do?
All right. So, Scott, I'm going to say something that might make the audience think I'm puzzling. But the move in DRAM, in my opinion, is actually somewhat defensive because we know that if you're worried about inflation and petroleum shortage, there's even bigger shortages in memory. So people are buying what's going to work even if the macro environment gets tough. And I think that's why it makes sense for semis and DRAM to still do really well. And so I think that this pullback is going to be viable there. But to me, if someone's trying to make a bigger bet on tech, I think the really attractive risk reward is still Mag 7 and software. And Bill Ackman's buy of Microsoft really reinforces it. That's why software is actually still among our top picks right now.
What stood out to me in this interview is that Tom Lee was not blindly euphoric. A lot of people try to paint bullish investors as irrational cheerleaders, but that is not really what he was doing here. He was actually trying to separate the long-term structural story from the short-term risks, and I think that distinction is extremely important, because too many people today are either completely bullish on everything or completely bearish on everything. Tom Lee seems to be saying both things can exist at the same time. Right from the beginning, the discussion starts with the idea that maybe this market rally has gotten a little out of hand. But the response is interesting because instead of saying the market is irrational, the argument was that earnings growth is actually supporting the move. That is a huge difference. A bubble built on hype alone is dangerous, but a rally supported by real earnings growth is a different story entirely. And that is really the core of this conversation. The market is not just going up because investors are dreaming about AI. Companies are actually reporting enormous earnings growth. That is why the PE ratios, which measure valuation relative to earnings, have not exploded the way many people expected. The E in PE ratios has been rising dramatically. In simple terms, if a company's stock price doubles but profits also double, the valuation may not actually become more expensive. That is one of the key arguments bulls like Tom Lee are making right now. Personally, I think this is where many retail investors misunderstand the current market. People see stocks like Nvidia flying higher every week and automatically assume it must be another dot-com bubble. But the difference is these companies are generating real cash flow, real profits, and real demand. This is not 1999, where companies with no revenue were suddenly worth billions. These are trillion-dollar companies printing enormous amounts of money. Now that does not mean there is no risk. There absolutely is. but the fundamentals are much stronger than critics want to admit. Then the conversation shifts into what might be the most important part of the entire interview, the idea that AI could fundamentally change the economy itself. Tom Lee starts talking about how economists traditionally think of economies being built on land, capital, and labor, but now he believes data has become the fourth factor of production. That is a massive statement, because what he is basically saying is that data itself has become one of the world's most valuable economic resources. And honestly, I think he is right. Every single day, people are generating unbelievable amounts of data through phones, apps, purchases, searches, social media, healthcare systems, logistics networks, and financial transactions. For years, much of that data just sat there unused. But AI suddenly gives companies the ability to extract value from that information at a scale humanity has never seen before. That is why this AI boom feels different. This is not just about chatbots making funny images or writing emails. This is about restructuring productivity itself. If AI helps companies make decisions faster, automate labor, optimize logistics, improve software development, accelerate drug discovery, improve customer service, and increase productivity across industries, then profits could rise dramatically for years. And I think that is what the stock market is trying to price in right now. The market may actually be signaling that AI is not just another tech cycle. It may be the next industrial revolution. That is why Tom Lee says AI might be a bigger deal than people understand. And honestly, when you really think about it, we are still early. Most businesses have barely integrated AI into their operations yet. We are probably still in the first innings of adoption, but then comes the other side of the argument. Tom Lee admits that even though he is bullish long-term, the next few months could become tricky. This is where the conversation becomes really balanced and realistic. He points out three major risks. The first is inflation and how the Federal Reserve reacts to it. The second is rising bond yields, and the third is the flood of IPOs potentially creating too much supply in the market. These are real concerns. The inflation issue especially matters because markets hate uncertainty around interest rates. If inflation suddenly starts rising again, the Federal Reserve may keep rates higher for longer, and that puts pressure on stock valuations. And honestly, this is where I think the market may be underestimating risk a little bit. The AI story is incredibly powerful, but macroeconomics still matters. Oil prices matter. Bond yields matter. Inflation matters. Investors sometimes get so caught up in momentum that they temporarily ignore the bigger picture. But at the same time, one thing I found really interesting was the argument that rising yields may actually reflect economic strength rather than economic weakness. That is an important nuance. If yields are rising because growth is improving, corporate profits can still remain strong, and that is exactly what the bullish side is arguing here. The interview also spends a lot of time discussing how insane the semiconductor rally has become. The host starts listing all the crazy numbers: semiconductor ETFs exploding higher, DRAM-related investments surging in assets under management, Nvidia going on another massive winning streak, the Nasdaq becoming so extended that it would need a huge drop just to reach its average trend line again. And honestly, hearing those numbers out loud does make the market sound overheated. You can feel the concern in the interviewer's voice. But the response from the bulls is basically this: yes, the moves are extreme, but the earnings growth is also extreme. That is the key battle happening right now on Wall Street. Are these stocks overvalued? Or are earnings simply growing fast enough to justify the move? And right now, the market is choosing to believe the second explanation. One thing that really caught my attention was Tom Lee calling semiconductors and memory stocks defensive. That sounds almost crazy at first. Traditionally, defensive investments are things like utilities, consumer staples, or healthcare. But Tom Lee is basically arguing that in a world dominated by AI, memory chips and semiconductors become essential infrastructure. In other words, if AI keeps growing no matter what happens in the economy, then the companies supplying the infrastructure behind AI may continue thriving even during tougher macro conditions. And honestly, there is logic to that. AI models require massive computing power. Massive computing power requires chips. Those chips require memory. And the demand for that infrastructure is exploding globally. So while the broader economy might slow down, certain areas of tech may continue growing because they are tied directly to the AI arms race. I also found it interesting that he specifically mentioned software as one of his favorite areas going forward. That is important because most investors are focused only on hardware companies like Nvidia, but eventually the real money may spread into software companies that successfully integrate AI into their platforms. Think about how much more valuable enterprise software becomes if AI can automate workflows, reduce labor costs, and increase efficiency. That may end up being one of the biggest investment opportunities over the next decade. And then near the end of the interview, we hear that massive prediction again. The S&P 500 target of 8250 by the end of the decade. That is a bold call, but when you understand the logic behind it, it starts making more sense. If AI dramatically boosts productivity, corporate earnings could grow far faster than traditional economists expect. And if earnings keep expanding, stock markets can continue climbing even if valuations stay relatively stable. That is really the entire thesis in one sentence. This is not just a speculation story. Bulls believe this is an earnings expansion story driven by a technological revolution. Now, whether that actually happens remains to be seen. There will absolutely be volatility along the way. There will probably be corrections. There will be inflation scares, recession fears, geopolitical tensions, and moments where investors panic. But what this interview really shows is that some of the smartest investors on Wall Street believe AI is reshaping the economic landscape in ways we still do not fully understand. And personally, I think that is the biggest takeaway from this entire discussion. The market may look crazy on the surface, but underneath it is a very serious bet on the future of productivity, data, and artificial intelligence. The question now is not whether AI changes the economy. The real question is how big that change becomes. And if Tom Lee is even partially right, then we may still be in the early stages of one of the biggest investment megatrends of our lifetime. Now, let's dive in and talk about the first company on this list is Constellation Energy, ticker symbol CEG. What makes Constellation Energy so fascinating right now is that this is not just another utility company trying to ride the AI hype cycle. This is a company sitting directly at the intersection of two massive global trends that are accelerating at the same time: artificial intelligence and the race for reliable, clean energy. And honestly, I think many investors still do not fully understand how important that combination could become. The world is entering a new era where computing power is becoming one of the most valuable resources on Earth. Every major AI model being trained today requires enormous amounts of electricity. We are talking about hyperscale data centers operating around the clock, consuming levels of power that were almost unimaginable just a few years ago. The problem is that AI infrastructure cannot simply rely on inconsistent energy sources. These systems need stable baseload power 24 hours a day, and that is exactly where Constellation Energy enters the picture. Constellation Energy is one of the largest producers of carbon-free energy in the United States. The company operates a massive fleet of nuclear power plants along with hydro, wind, and solar assets. But the nuclear side of the business is what makes this story so compelling in the AI era. Nuclear energy is suddenly becoming strategically important again. For years, nuclear was viewed by many investors as an aging industry with limited growth potential. But AI is changing that narrative very quickly because artificial intelligence requires enormous reliable energy production, and nuclear happens to provide exactly that. Unlike solar or wind, nuclear plants generate constant electricity regardless of weather conditions. That reliability becomes incredibly valuable when AI data centers need uninterrupted power every second of every day. This is why investors have started paying much closer attention to Constellation Energy. The company is no longer being viewed as just a traditional utility. It is increasingly being viewed as critical AI infrastructure, and that is a very different investment story. One of the biggest things working in Constellation Energy's favor is scale. The company owns the nation's largest fleet of nuclear reactors, producing enough electricity to power millions of homes and businesses across the country. That gives it an enormous competitive advantage at a time when energy demand is expected to surge because of AI expansion. Data center electricity demand is exploding. Major technology firms are racing to build larger AI campuses, larger cloud infrastructure systems, and larger training clusters for advanced AI models. Every new generation of AI requires more computational intensity than the last. That means more servers, more cooling systems, more infrastructure, and ultimately, far more electricity. Some analysts now believe AI could become one of the largest drivers of power demand growth in decades. That is a huge shift because for years electricity demand growth in developed markets was relatively stagnant. AI may completely reverse that trend, and companies like Constellation Energy are positioned directly in the middle of that transformation. What I personally find most interesting is that Constellation Energy benefits from both the AI boom and the clean energy transition at the same time. Usually investors have to choose between growth and stability, but Constellation potentially offers both. The clean energy angle matters because many of the world's largest technology companies have aggressive carbon reduction goals. They want clean electricity to power their AI operations. Nuclear energy gives them a scalable carbon-free solution that can operate continuously. That combination could create enormous long-term demand for Constellation's power generation assets. Financially, the company has also been performing strongly. Earnings growth expectations have improved significantly as electricity demand projections rise and power prices remain favorable. Investors are starting to recognize that Constellation may have years of strong cash flow generation ahead if AI-driven electricity demand accelerates the way many expect. Another thing that strengthens the investment thesis is the difficulty of replacing or replicating what Constellation already owns. Building new nuclear infrastructure in the United States is extremely expensive, highly regulated, and incredibly time-consuming. In many cases, it can take well over a decade to develop new facilities. That creates a powerful moat around existing operators. In other words, Constellation's assets are becoming more valuable precisely because they are so difficult to recreate. That scarcity could become a major advantage as AI demand intensifies. One thing I think many retail investors miss is that AI investing is not just about software and semiconductors. Every technological revolution creates secondary winners that often become just as important as the companies grabbing the headlines. During the gold rush, many of the biggest fortunes were made selling the tools, and in the AI revolution, energy providers may become some of the most important tool suppliers in the entire ecosystem. Because without electricity, none of this works. Not the data centers, not the cloud systems, not the training models, not the inference engines, nothing. That is why companies like Constellation Energy deserve much more attention than they are currently getting from mainstream investors. Another reason I like this business long-term is the durability of demand. AI infrastructure is not something companies can casually turn on and off. Once these massive AI ecosystems are built, they become deeply integrated into enterprise systems, cloud networks, productivity tools, and consumer applications. That creates recurring electricity demand that could last for years. And because Constellation operates regulated and contracted energy infrastructure, the business model also carries a level of predictability that many high-growth tech companies simply do not have. That balance between growth exposure and infrastructure stability is one of the biggest reasons institutional investors continue accumulating shares. The company has also benefited from improving sentiment around nuclear energy globally. Governments and corporations are increasingly recognizing that achieving energy security while reducing emissions may be nearly impossible without nuclear power playing a major role. That political and regulatory shift could create an even more favorable environment for companies like Constellation going forward. And honestly, timing matters here. A lot of investors wait until a trend becomes obvious before they pay attention. By the time everyone fully understands the importance of AI energy infrastructure, many of these stocks may already be trading at much higher valuations. The market usually moves ahead of public perception. That is exactly why this story is so interesting right now. You are starting to see a gradual revaluation of companies connected to long-term AI infrastructure needs. And Constellation Energy may still be in the early stages of that process. Now, that does not mean the stock is risk-free. No investment is. Energy markets can be volatile. Regulatory environments can shift, electricity pricing can fluctuate, and if economic conditions weaken significantly, market sentiment toward infrastructure stocks could also become more volatile in the short term. But from a long-term perspective, the core thesis remains extremely compelling. Artificial intelligence is increasing global electricity demand, reliable clean energy is becoming more valuable, nuclear power is regaining strategic importance, and Constellation Energy already owns one of the largest nuclear power fleets in the country. That combination creates a very powerful setup. One thing I also appreciate about this company is that management appears to understand the magnitude of the opportunity ahead. The company has been positioning itself aggressively around the future of clean energy demand, and investors are increasingly rewarding that strategy. The stock has already delivered strong performance, but many analysts still believe the long-term runway remains significant because the AI infrastructure build-out may only be getting started. And honestly, this may be one of those situations where the market initially underestimates how quickly electricity demand can accelerate. We have seen this pattern before throughout history. When a transformative technology emerges, the supporting infrastructure often becomes just as important as the technology itself. Railroads powered industrial expansion. Telecommunications networks powered the internet revolution, cloud infrastructure powered modern software, and now energy infrastructure may power the AI revolution. That is why Constellation Energy deserves serious attention from long-term investors looking for exposure beyond traditional AI stocks. Because while everyone else is chasing the obvious names, companies like Constellation may quietly become some of the most important backbone businesses of the entire AI economy. And if AI adoption grows anywhere close to the levels many experts are projecting, the demand for reliable electricity could become one of the defining investment themes of the next decade. That is exactly why Constellation Energy stands out as one of the best AI energy stocks to buy now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second company on this list is Vistra, ticker symbol VST. If Constellation Energy represents the clean baseload side of the AI energy revolution, then Vistra represents something equally important: scale, flexibility, and the ability to capitalize on surging electricity demand across multiple energy markets. And honestly, I think Vistra may be one of the most misunderstood companies benefiting from the AI boom right now. A lot of investors still view Vistra as just another power generation company, but when you really look beneath the surface, this business is becoming increasingly important in a world where artificial intelligence is pushing energy demand to levels the market was not prepared for. Remember, every AI model, every cloud server, every large language model, every data center expansion project requires one thing above all else: massive and reliable electricity generation. That demand is growing rapidly. And Vistra already owns one of the largest competitive power portfolios in the United States. The company operates a diverse mix of natural gas, nuclear, solar, and battery storage assets across major power markets. That diversification gives Vistra a strategic advantage because the future grid likely will not rely on one single energy source. Instead, the future energy system may require a combination of stable baseload generation, flexible dispatchable power, renewable integration, and energy storage. Vistra is positioning itself directly into that future. One thing that immediately stands out about this company is operational scale. Vistra generates electricity for millions of residential, commercial, and industrial customers across the country. That kind of footprint matters because AI-driven electricity demand is not expected to remain isolated to one region. This is becoming a national infrastructure story. As more AI campuses and hyperscale data centers are built, utilities and energy producers capable of supplying large-scale electricity demand could become increasingly valuable, and Vistra already has the infrastructure in place to benefit from that shift. What makes this particularly interesting is that many investors still underestimate how energy-intensive AI truly is. Training advanced AI models requires enormous computational resources. Even after models are trained, inference demand continues consuming huge amounts of power every single day as millions of users interact with AI systems online, and the next generation of AI systems will likely require even more energy than the current generation. That creates a long-duration demand cycle that could stretch far into the future. Personally, I think this is one of the most important shifts happening in the market right now, but many investors are still too focused on the surface-level AI trade. Everybody talks about chips, everybody talks about software, but very few people are discussing the companies powering the entire ecosystem behind the scenes. Without scalable electricity infrastructure, AI expansion eventually hits a wall. That is why businesses like Vistra are suddenly attracting more investor attention. Another thing I find compelling about Vistra is the company's exposure to natural gas generation. Now, I know some investors immediately hear natural gas and assume that conflicts with the clean energy transition, but the reality is much more nuanced than that. Natural gas remains one of the most important bridge fuels in the modern power grid because it provides flexibility and reliability when renewable output fluctuates. AI data centers cannot afford instability, they cannot afford intermittent power disruptions, and they certainly cannot pause operations because weather conditions suddenly change. That means dispatchable energy sources still play a critical role in maintaining grid stability. Vistra's diversified generation portfolio allows the company to participate in multiple energy trends simultaneously, rather than depending entirely on one single source. That flexibility matters, especially during periods of volatile power demand. The company has also invested heavily in battery storage and renewable integration, positioning itself for the long-term evolution of the energy grid. Battery storage in particular may become increasingly important as AI-driven electricity consumption grows. Why? Because battery systems help stabilize the grid, improve efficiency, and manage peak electricity demand periods. As energy consumption rises, storage technology could become a much larger piece of the overall energy infrastructure puzzle. Vistra understands this, and investors are beginning to recognize it too. Financially, the company has delivered impressive momentum. Strong electricity pricing, disciplined operations, and improving market conditions have supported earnings growth and free cash flow generation. The company has also been returning capital to shareholders through share repurchases and other shareholder-friendly strategies. That combination of infrastructure exposure and capital returns makes the stock especially interesting for long-term investors. And honestly, this is where I think Vistra separates itself from many speculative AI-related investments. A lot of AI stocks today are priced entirely on future expectations, but Vistra is already operating profitable infrastructure assets today. It already generates cash flow, it already owns critical energy infrastructure, and it may still benefit enormously if AI-driven electricity demand accelerates over the next decade. That creates a much different risk profile than many high-valuation technology companies. Another thing that strengthens the Vistra thesis is the simple reality that building new energy infrastructure in the United States is becoming increasingly difficult. Permitting takes time, regulatory approvals take time, construction costs continue rising, and grid modernization projects often move slowly. That means existing large-scale operators like Vistra may become increasingly valuable because they already control infrastructure assets that would be extremely difficult and expensive to replicate from scratch. Scarcity matters, especially during periods of rising demand, and this may become one of the defining characteristics of the AI energy trade moving forward. The companies that already own scalable power infrastructure may possess enormous strategic advantages over companies trying to build capacity later. One thing I think investors should pay close attention to is the broader transformation happening inside the electricity market itself. For years, many people assumed electricity demand growth in developed economies would remain relatively flat because of efficiency improvements and slower industrial expansion. Artificial intelligence may completely change that equation. AI data centers are consuming staggering amounts of power, and the demand projections continue rising. Some estimates suggest future AI infrastructure could require electricity consumption levels comparable to entire cities. That is not a small trend. That is a structural shift. And when structural shifts happen, infrastructure companies often become some of the biggest long-term winners. We saw this with railroads during industrialization. We saw this with telecom networks during the internet era. We saw this with cloud infrastructure during the software revolution. Now we may be seeing the early stages of a similar transformation happening within the energy sector, and Vistra is positioned directly in the middle of it. Another thing I personally like about this investment story is the balance between offense and defense. On one hand, Vistra gives investors exposure to a major long-term growth theme through AI-driven electricity demand. On the other hand, electricity itself remains an essential service regardless of economic cycles. That creates a level of resilience many pure growth companies simply do not have. People may reduce discretionary spending during economic slowdowns, but the world still needs electricity, and AI infrastructure certainly will not stop consuming power. That combination of essential infrastructure and long-term growth exposure creates a very attractive setup for patient investors. The market also appears to be slowly revaluing power generation companies because investors are starting to realize how critical electricity infrastructure could become in the AI era. For years, many utility and power generation businesses traded at relatively modest valuations because growth expectations remained low. AI may fundamentally change those expectations. If electricity demand growth accelerates meaningfully over the next decade, companies capable of supplying large-scale power generation could become much more valuable than investors previously assumed. And honestly, I think we are still early in that realization process. One thing investors should also consider is that AI competition is becoming global. Countries around the world are racing to build AI leadership. Technology companies are investing hundreds of billions into AI infrastructure. Governments are prioritizing domestic computing capabilities, and all of that requires one foundational ingredient: energy. reliable energy, scalable energy, continuous energy. That is exactly why energy companies connected to AI infrastructure demand may become some of the biggest long-term beneficiaries of this technological transformation. Vistra fits directly into that theme. Now, of course, there are risks investors need to understand. Electricity markets can be cyclical. Commodity prices can fluctuate. Regulatory policy changes can impact profitability. Interest rates can influence infrastructure valuations, and broader market volatility can affect investor sentiment toward energy stocks. But despite those risks, the long-term thesis remains very compelling. Artificial intelligence is increasing electricity demand. Power infrastructure is becoming more strategically valuable. Existing generation assets are becoming harder to replace, and companies like Vistra already possess the scale, operational footprint, and market positioning needed to capitalize on those trends. That is why Vistra stands out as one of the best AI energy stocks to buy now. And when you step back and look at the bigger picture, something very important becomes clear. This AI revolution is not only creating winners in software and semiconductors, it is also creating winners in infrastructure. Because every technological revolution eventually runs into physical limitations. The internet needed fiber networks, cloud computing needed massive server farms, electric vehicles needed battery supply chains, and artificial intelligence needs enormous amounts of electricity. That may end up being one of the most important investment themes of the next decade. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which company do you think has the stronger long-term advantage in the AI energy race? Constellation Energy with its massive nuclear fleet and clean energy positioning, or Vistra with its diversified power infrastructure and flexible generation portfolio? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.